Imagine owning real estate that pays you rent every single month without ever having to buy a house, deal with tenants, or fix a broken toilet. That's exactly what REITs can do for you. Today, let's break down what REITs are, how they work, and why they might be an investment worth understanding. Number 1. What does REIT stand for? REIT stands for Real Estate Investment Trusts. Think of them as companies that own or manage real estate properties, things like shopping malls, office buildings, apartments, hospitals, even data centers. Instead of you buying an entire property on your own, you can buy shares in REITs, just like buying stock. By holding these shares, you own a small piece of a big real estate portfolio. Number 2. How do REITs make money? The business model is simple. REITs collect rent or lease payments from tenants. That money becomes income for REITs. By law, REITs must pay out at least 90% of their taxable income back to shareholders as dividends. So if you invest in REITs, you're essentially receiving a share of the rental income without ever having to be a landlord yourself. Number 3. Types of REITs. Not all REITs are the same. Here are the main types. Equity REITs. These own and operate real estate. They make money mainly from rent. Mortgage REITs. Instead of owning buildings, they provide financing for real estate, earning money from interest. Hybrid REITs. A mix of both. Most beginner investors start with equity REITs because they're easier to understand. The companies own buildings, tenants pay rent, and you get a share of the profit. Number 4. Why do people invest in REITs? There are a few key reasons. Passive income. REITs pay regular dividends, often higher than average stock dividends. Diversification. You're adding real estate to your portfolio without buying property directly. Liquidity. Unlike physical real estate, REITs are traded on stock exchanges, so you can buy and sell them like regular stocks. For many people, it's the easiest way to add real estate exposure to their investments. Number 5. Risks of REITs. Of course, no investment is risk-free. Market risk. REITs prices can go up or down like any stock. Interest rates. When interest rates rise, REITs prices often fall, since borrowing costs go up and investors look for safer income alternatives like bonds. Sector risks. If you invest in REITs that own only shopping malls and retail declines, your investment could be hit harder than a diversified REITs portfolio. The key is to research the type of REITs you're investing in and understand the sector they focus on. Number 6. How to invest in REITs. Getting started is simple. In most countries, you can buy shares of publicly traded REITs through your stockbroker, just like buying Apple or Microsoft stock. You can also invest in REITs ETFs or mutual funds, which bundle together multiple REITs to spread out the risk. So, what are REITs? They're your chance to invest in real estate, earn rental income, and diversify your portfolio, all without the hassle of being a landlord. If you found this breakdown helpful, make sure to hit like, drop a comment if you have questions, and subscribe to Finance Talkin' for more simple explanations about money and investing.